Let's bring in Aaron Smith. He's Managing Director of Superfund Financial, joining me here in the Hong Kong studio. Good morning, Aaron. Now, of course, the markets were a little bit nervous about the non-farm payrolls. We also have Ben Bernanke going over to meet the Senate and the Budget Committee. What are you expecting to come out of his assessment of the U.S. economy?
Well, in economic terms in the United States, we expect the outlook to remain sort of anemic for 2011. That does not mean, however, that equity prices will not perform well. We do see an uptrend, a moderate uptrend in equity prices in the stock markets in the United States. We expect that to continue as long as real interest rates are giving you a negative return. Stocks will continue to rise, and we'll be able to ride that trend using stock futures. So there's actually a disconnect between what we see in the economic growth of the United States and what the equity market will do in 2011. Another thing to point out is that, like the issues in Europe, we have some municipalities in the United States that are in jeopardy of defaulting, and that can start sort of a domino effect that leads to corporates and even some sovereign nations.
All right, and having said that, you are expecting a disconnect. How should investors be playing the market then?
Well, the best way to get exposure to the equity markets, I think, is certainly not through the traditional long buy and hold stock approach. I would look more towards equity market neutral systems where you have the upside exposure to the equity market, but you've capped your downside risk. So equity market neutral systems performed very well in 2010. We expect that to continue with a fraction of the risk that you have by just investing in, say, the S&P 500 or any broader equity market index.
As far as equities are concerned, now you're advising investors to stay out of the bond market. Why?
Well, you got to stay out of the bond market from this point because rates are at a low that they've been at a historical low for a period of time that's unprecedented. And what happened in response to the tech bubble was this, bringing rates down by the Fed down to 1%, which created subprime. Now we're down to zero for a longer period than what we saw then. So what we can expect is something that could be even more dramatic than subprime, what would actually be a monetary crisis. So by investing in bonds, not only do you have default risk by municipals, corporates, and even some sovereigns, you don't even get a real return after inflation today in almost any issuer in the world. So just common sense says that bond markets are not the safe haven that investors think they are. So we would look at other markets, potentially equity market neutral strategies, potentially soft commodities as better opportunities for investment.
All right, Aaron, stay right there. We're going to be getting back to you in just a moment. That's Aaron Smith with me. But in the meantime, some other stories that we're keeping an eye on for you. In corporate news, Facebook may be forced to disclose its financial data. Welcome back, and thanks for staying with us on the call. Let's get back to Aaron Smith. He's a Managing Director of Superfund Financial. Now, Aaron, before the break, you were telling us that there's a disconnect between the equity markets and the economy in the United States. Now, I was reading this morning a fund managing company saying that China is going to be leading an economic slowdown in Asia this year, and investors should be welcoming this. Do you agree with this? And what is your assessment of the Chinese and Asian markets?
I don't necessarily see a slowdown in China in particular, but I do see a big caveat for the region in general. Throughout Asia, one of the predominant themes for 2011 is going to be food inflation. Okay, we've already seen the United Nations Food and Agriculture Index up 6 months in a row. People really didn't realize that food prices were up double digits last year. So in response, RBI had to raise rates 6 times last year. The central bank in China had to raise rates. And this is just a foreshadowing of what can start to happen in the West. So the days of cheap food are over. We see sugar trading at 30-year highs, coffee trading at 13-year highs. Meanwhile, all of these soft commodity products, sugar, cotton, these are trading at more than 60% discounts to their inflation-adjusted all-time highs. So the upside potential in the foods and commodities is very, very high. Couple that with potentially rising energy markets, that can put a little bit of a damper on the economy, and it's obviously going to be quite problematic from a social standpoint for certain economies like in the Philippines, Vietnam, various countries in Southeast Asia.
How big a role is China going to be playing in the rise in commodity prices?
Well, they're going to play the largest role in the world. They are the largest producer and consumer of commodities worldwide. So we see that continuing. We do believe that the Chinese story is resilient, but the way to play that story is not necessarily by buying equities. The way to play that story is by getting exposure to the commodity products that I mentioned. One thing we do expect is that the equity to gold ratio will continue to decrease as it did in 2010. So we wouldn't be surprised to see the Dow to gold ratio go down to about 6 this year, and that could even go to the low single-digit levels in the next few years. So the Chinese story remains intact. It just may not be manifested through returns in equity markets.
And how much will this be exacerbated by the crazy weather that we're seeing? Of course, the floods down in Australia, and then there is drought in the western coast of Latin America.
Yeah, well, with the floods, I'm glad I got that lump of coal for Christmas. But that will come. Steel prices will jump because of that temporarily. But if you look at commodities across the board, we're going to have to wait till the summer until we have any chance of a major pullback when, harvests start to come due. So right now, there's no real downside that we see in the agricultural markets. So commodities in general are looking very, very strong. And that also goes into the metals that I discussed. Copper's trading at a 27% discount to its inflation-adjusted all-time high. We see great potential in other base metals as well. Precious metals, especially like silver, we do expect to increase. I see silver trading at $60 an ounce potentially in the next 2 to 3 years.
And just very quickly, as far as emerging Asia is concerned, which markets are you liking this year?
Well, I think the whole basket is very compelling. I think probably the most compelling story that I've seen in my travels has been India. There is tremendous opportunity. I would applaud RBI by being aggressive in their stance on their monetary policy, contrary to what we see happening in the West. So I do see a lot of opportunity in India, where it's a very educated, high-saving, English-speaking populace. On the other hand, there's great opportunities in some of the Asian tigers and in some of the Southeast Asian markets. So I would look at some of the countries that are outside, Hong Kong, Singapore, looking in the region to some of the undervalued plays.
All right, thanks very much for sharing your thoughts with us and stopping by. We've been speaking with Aaron Smith. He's a managing director of Superfund Financial. We're going to go for another short break here, but coming up, we are just minutes away